Hello, hello. Welcome everybody to another presentation. If you can hear us and you can see us, please drop a note in the chat so that we can know that you are here. And we will get started in just a second. Let's see, we got a couple people in the room. Just let us know. I know there might be a little bit of delay, but let us know that you can hear us and see us. This today, oh, yeah, you can hear. Awesome. All right, so we're going to get going. All right, so welcome to today's presentation, Practical ESOPs, ESOPs, Liquidity Today, Flexibility Tomorrow. So if any of you guys were here a couple of weeks ago, we did have an intro to ESOP strategies, and that one went over very well. Everybody was really interested in this avenue for our clients in the cannabis industry. So I thought we'd go a little bit deeper with the training here. And today I brought on Andrew Nikolai, and he is the managing director at CSG Partners. And he is going to take us through a presentation. So Andrew, if you can just introduce yourself, let us know about your background, and then we can go ahead and get started.
Sure. Yeah. Thanks, Naomi, and excited to be here today. Like you said, Andrew Nikolai, managing director here at CSG Partners. Been with the firm for close to a decade now, and I help lead our efforts in the cannabis industry. So I've personally been involved in about a dozen or so now ESOP transactions within the cannabis industry. We're seeing a lot more interest. There's obviously a lot to talk about in terms of rescheduling and 280E. So we'll touch on that and how that impacts ESOPs as well. But excited to be here today. I'm going to go ahead and share my screen, and we have some questions, some slides that we'll walk through. Feel free to ask questions as we go. I'm happy to take them live as we start to get into some of the information.
Awesome. Okay, so I don't see your screen yet. Oh, there we go. Okay, awesome. And I know a lot of you guys had questions from last presentation, so feel free to drop those in the chat and we'll ask them as we go. Oh, it came up a little strange this time.
Let's see. Is this better?
Oh, perfect. Yes.
Okay. So just a quick little background on our firm. CSG Partners is an investment bank headquartered here in New York City, which is where I sit. But we have a nationwide ESOP practice. We've been around for over 25 years. We've done over 400 ESOP transactions, and over the past couple of years have spearheaded ESOPs for the cannabis industry. Like I said, we've done about a dozen of them so far, dating back as far as 2023. And we've been working with a number of other firms. There's a lot of interest within the cannabis space, and this is certainly a new topic that may be complicated on some levels, but we'll try and talk through things simply and go through kind of how an ESOP works and what some of the pros and cons and advantages are specific for the cannabis industry. So to start, many of the clients that we work with, they own a privately held business in the cannabis industry, and the first thing that they're concerned about is liquidity. They've built up a business, have gone through the process of getting licenses, which can be complicated, obviously, on its own, investing in stores and cultivation facilities, getting everything set up. And now they have a business that is cash flow positive, making money, but a lot of the cash goes into either paying taxes, reinvesting into growth, and there's not much left over at the end of the day. So not a lot of liquid cash flow on an annual basis, and it can also be challenging to find third-party buyers in the current environment. So on top of that, if there are options out there to sell the business to a third party, a lot of owners are concerned about what happens to the business that they built, how is the culture or the employees impacted, and what are some of the other impacts of a sale if they are going through and getting some liquidity out of the business. But at the same time, most business owners have up to 80% of their wealth tied up in the business. And so looking at some sort of liquidity strategy to get money out, take some chips off the table, diversify wealth is a common concern that we hear, and is what leads to potentially considering an ESOP, but really considering any sort of transaction option. So just to quickly touch on 280E, I think everyone on this call is well familiar with this, but it's very unique. We found out about 280 a couple years ago. Like I said, we've been helping companies in virtually every other industry use an ESOP structure to operate tax-free. And when we found out about 280E and the inability to deduct, a lot of operating expenses for tax purposes, we immediately found the synergy between ESOPs for the cannabis industry. So we'll talk about how we're able to access that benefit. We know that there's been an executive order signed to accelerate and move forward with the rescheduling process. To date, cannabis has not yet been rescheduled, so still, all cannabis companies are subject to 280E until that process is officially concluded. The timeline of rescheduling is a little bit uncertain. Everyone I talk to has a different opinion on exactly when it's happening, potentially if it's going to happen at all. But there's definitely a lot of optimism now in recent, weeks and months that rescheduling is going to happen, and it's just a matter of when. So that will certainly bring some much needed tax relief to the overall industry. That being said, companies will still be subject to standard federal and state income taxes, which can still be a pretty material tax burden. So it's helpful. It'll be better than how companies have had to operate for most of the history of the industry, but there are still tax obligations that will be due even if cannabis is rescheduled. And so we'll talk through. I know we get the question all the time, if it's rescheduled, 280 goes away, does an ESOP still make sense? So we'll talk a little bit about that and how to think about ESOPs in the context of a post 280E environment. So just briefly touching on what is an ESOP. An ESOP, at the end of the day, is a defined contribution plan. It's governed by ERISA, which also oversees 401k and other retirement plans. It's also subject to oversight by the Department of Labor. But at the end of the day, an ESOP is a way to sell a business that's privately held at fair market value. There are a lot of tax advantages involved for ESOPs. So we often think about an ESOP as a tax advantage leverage buyout of your own company. You're going to leverage the balance sheet, take advantage of the tax incentives that are created for ESOPs in order to support the transaction. These transactions are generally financed by third-party lenders that provide sellers with cash up front, and then sellers are often providing some level of financing as well for the balance of the purchase price. And the material tax benefit, specifically with 280E and even without it, is the ability to structure a 100% ESOP-owned company that can operate 100% tax-free, which often leads to cash flow improvement for many cannabis companies of up to 200%. So it's a material tax benefit that can be very powerful. Those tax savings then support the debt from a transaction, but they can also be used to accelerate the company's growth, to go out and make acquisitions. Once you have a vehicle that's earning cash flow, that's not taxed and isn't subject to taxes into perpetuity, it can be used to invest in other growth initiatives, whether that's making acquisitions, but also a new cultivation facility or other things like that. So just continuing down on how does an ESOP work. So to start, a trust is set up that becomes the buyer in this transaction. All of the employees of the company are the beneficiaries of this trust and are the ones that will receive shares through the ESOP over time. The purchase price is a negotiation. There's a trustee that's hired that negotiates all of the terms on behalf of the employees of the company. They rely on guidance from their counsel and from their valuation advisor, and they sort of make up the buy-side team of an ESOP transaction. We help advise the company and the sellers and go back and forth and negotiate within that fair market value range that was talked about. These transactions are funded with third-party financing, but also with seller financing. We'll get into a little bit more detail on financing options for the cannabis industry which, as everyone knows, are much more limited than other industries. Hopefully, with rescheduling, once it goes through, that'll help pave the way for some improvement in capital markets. But generally, there's some cash up front through a third-party lender, and then the sellers provide or receive a note for the balance of the purchase price. Shares are allocated out to all employees of the company that satisfy eligibility requirements. And generally, shares are split up among employees based on compensation. So each employee's salary and bonus as a percentage of total company compensation is a percentage of the shares that they'll receive through the ESOP. Shares are generally subject to a vesting schedule over 3 to 6 years. And over time, employees will build up value in their ESOP account, receive more shares every year, and we'll see what the price per share is. And at some point in the future, when they go to retire, or if they depart the company, they have the right to convert the value of their ESOP to cash by selling those shares back to the company. So quickly touching on the structure of a standard leveraged ESOP. So as I mentioned, for the cannabis industry, there are a group of lenders out there that are willing to provide loans to cannabis operators. The cost of capital is certainly higher than other industries due to the limited sources of capital available. But there are some commercial banks that are willing to provide loans to cannabis operators, especially if there's any real estate that's owned within the business. And then there's also a few more credit funds and mezzanine investors that will also provide loans just at a higher cost of capital. So the upfront financing is a loan that's provided to the company and secured by the company's cash flows and the assets of the business. We are generally not raising capital with any sort of personal guarantees involved. So the loan that's made to support the transaction is recourse just to the company and its assets, and it's supported by the tax efficiency that's created from an ESOP. That cash is then loaned from the company to the ESOP, and the ESOP uses the cash to purchase the equity from the selling shareholders. So the ESOP trust that's set up, that's buying the shares, is a newly formed trust for each transaction. It's not coming to the table with any cash or assets like a private equity firm, for example. So this financing structure is important because ultimately it's what provides the sellers with that upfront cash payment at the time of the transaction. If there's a difference between the sale price and the amount of financing that's raised, in step number 4, you can see there's then a seller note that is issued to the selling shareholders for the difference between the purchase price and the cash amount. So here we're going to look at some of the benefits of an ESOP transaction, and it's partially based on the taxes and the tax incentives. There's specific codes in the tax section that create incentives to go down the path of an ESOP, but there's a lot of other benefits involved as well. So to start, an ESOP is a known buyer. It becomes more of an internal friendly type of transaction. You don't need to necessarily go out and market the company to a third party. Like I said, we're going to set up the trust to create the buyer and set up the transaction. Sellers are able to go through a transaction at fair market value. But on top of that, under Section 1042 of the tax code, which operates very similar to Section 1031, when you sell a privately held business to an ESOP, you are able to defer and potentially eliminate capital gains taxes on the sale. So on top of receiving fair market value, if you can do so tax-free, it optimizes the after-tax proceeds and can make it even more attractive than selling to a third party. We also often structure upside for the sellers in these transactions where either they retain stock or warrants or some form of synthetic equity. So even though you're selling some or all of the business to an ESOP, you can retain material upside and be incentivized to continue to grow the business going forward. From a tax efficiency perspective, if it is a minority transaction, the company will receive a bucket of tax deductions equal to the sale value, and it can access those tax deductions to shield and offset its taxable income on an annual basis post-transaction. But the goal is always to get to 100% ESOP-owned S-Corp status, and that will allow the company to operate 100% tax-free and allow the business to use pre-tax dollars and pre-tax cash flow to pay off any loans created from the ESOP transaction. Lastly, in terms of the employee side, the ESOP creates a very unique benefit to employees. It's something that not many companies have, especially in the cannabis industry. It allows all of the employees of the company to benefit in the performance and the growth of the business, and really creates an ownership culture. It oftentimes will enhance the business's ability to attract and retain talent, especially within the cannabis industry. We know from many of our clients that turnover can be a little bit higher, especially at the dispensary and the retail level, where staff is willing to leave and go to another cannabis company for another $1 or $2 raise per hour. Providing this ESOP and equity incentive to all those employees generally leads to much greater retention and can help solve some of those challenges at the workforce level. Lastly, from the company's perspective, it does allow the business to retain its independence, and the board of directors continues to oversee and run the operations. The trustee of the ESOP does not ever sit on the board of directors. They don't really want to get involved in operating the business. They want the team that's running the company today to continue to run the business tomorrow. So the board and the existing ownership group that typically sits on the board can continue running the business. And the last thing to touch on in terms of future transactions. So we know that a lot of business owners in the cannabis industry see a lot of upside if federal legalization happens at some point in the future, or maybe a little bit younger and still have a long-term horizon. And they're not looking necessarily to retire or to walk away from the business. So structuring an ESOP to receive some money and take some chips off the table, but still have a material ownership stake in the business is certainly possible. And it does not restrict future ability to sell to a third party, terminate the ESOP and buy it back. There's a lot of different options that can be taken down the line. But it's important to note that an ESOP does not have to be permanent, and it doesn't restrict or impact future options for the business. So getting into a little bit more detail on 100% ESOP owned S Corp, which is ultimately the end goal for most ESOP transactions. As an S Corp, the business is structured as a pass-through entity. And so if you're 100% owned by an ESOP, you have one K1 every year on your tax return. The ESOP is the only owner of the business and the only one that receives a K1. And because an ESOP is a tax-exempt retirement plan, the ESOP does not have to pay taxes. So it doesn't necessarily mean that all of the cash flow has to be distributed out to the ESOP. It can still stay within the business, like I said, and be used to invest in growth and other initiatives. What it does mean is that the ESOP is the only one that has to recognize the income from the business. And because the ESOP does not have to pay taxes, that's how we're able to structure 100% tax-free business.
Hey, I just wanted to interject. Okay. And I'm still trying to understand how this works, because I know in the cannabis industry, we always say, no, S Corp is just not the best option, but it seems like ESOP, that's the way it works. So the owners own the ESOP and the ESOP owns the S Corp. And is that how they prevent the flow? Well, I know the ESOP's not taxed, but is that how they protect themselves from the flow through 280E taxes?
So yeah, most of the time, our clients in the cannabis industry start as a C Corp or an LLC taxed as a C Corp because of 280E. So what we do is close the transaction initially while the company is still a C corporation, and then immediately post-transaction convert to an S corp. So now that you've closed the transaction, the ESOP owns the company. That's when you convert to an S corp, and now the ESOP owns a company that is an S corp, and that creates the tax-free structure. We don't want to make the S corp conversion prior to the ESOP taking ownership. Otherwise, we would create, pass through and tax liabilities for the existing ownership group. So it takes a little bit of kind of structuring and tax planning, but there are ways to make sure that, we initially close the transaction as a C corp and then convert to an S corp after the fact.
And then this is a interesting audience question. So does the ESOP own the cannabis license? They're specifically asking for the state of Massachusetts, but I guess in general.
Yeah, so we've actually done, I think, 4 or 5 ESOPs within Massachusetts in the cannabis industry. So it's definitely been the most popular state by far. Generally, the company owns the licenses and continues to own the licenses post-transaction. Or, we can transition the license to be owned by the company as part of the transaction planning. It does require a change of control approval, which can take some time in any state. So generally, we're filing those change of control applications early on in the process. The good thing is with an ESOP, there's no new operator coming in. Like I said, anyone who's on the license today and has already been approved is going to continue to stay on the license tomorrow after the transaction. So we don't need to necessarily go through, get new individuals fingerprinted and approved by CCC or other state regulators. We can just explain the structure of the transaction to them and how the existing ownership group is going to stay on the license and maintain control of the operation even after the ESOP owns the equity.
Okay. So John Doe, went out, was approved for a cannabis license. The license is technically kind of in my name. I formed this company. I'm transferring the license to the company, and then the company is being transferred into an ESOP. So the company owns the license, but then the ESOP owns the company, and then we transition to an S corp.
That's right.
Okay.
Yep. And in certain states, we know that there are restrictions on who can own some of these licenses. So another workaround that we've used is having an individual maintain ownership of a license and just granting the company that's being sold to an ESOP the use of that license through some sort of management services agreement. So it's another way where we can still have the value of the license kind of flow into the entity that's being sold to the ESOP without running into any issues in terms of actual ownership of the license.
And then there was another, it's kind of related, another question that came up earlier about how an ESOP works in the state of New York because of, are you familiar with their TPI rules, the true party of interest rules?
Vaguely familiar, yes.
So they have individuals or companies can only own certain, have a certain level of ownership in the cannabis industry within the whole entire state. I wouldn't be able to tell you step by step, but it's like you can only own so much. So I guess if you are involved in ESOPs in a bunch of different businesses, it might go above and beyond the percentage ownership that's allowed on their rules.
Yeah, and I think what that may come down to, what we've seen in other states like Massachusetts, like we were talking about, for example, is the trustee of the ESOP is the one. So even though the ESOP is for the benefit of all the employees are really beneficiaries of this trust. They have beneficial ownership and not true ownership. So we don't see regulators testing or analyzing the flow through ownership of the ESOP. But what they do look at is the trustee of the ESOP, because that trustee is the one who ultimately is technically, potentially being added to the license. So we've used certain structures before where we have someone internal to the company take over as the trustee of the ESOP post-transaction. But I think specific to New York, it would depend on the exact ownership structure. And, it would be a little bit detailed based on the exact situation. But basically, in summary, we've worked around, limitations in other industries. So we can generally find a workaround, but it'll be situational.
Okay. Okay. Yeah, I think that Craig, let us know if that didn't answer your question, but it sounds like the true party of interest is kind of one or two removed because now it's owned by a trust. And that trust may only own that one ESOP, and you can just create another trust for if you have another.
That's right. And it just depends on certain states will only test ownership. Other states will also pick up control, even if you don't have ownership. So I think it'll depend on the exact, I'd have to look into the TPI rules a little bit more, but exactly how they're, testing individuals is based on ownership, control, a combination of both. And then, figuring out the best structure with the trustee and, who's trustee of the ESOP post-transaction may help to solve any issues there.
Yeah, and I'm pretty sure that you guys have probably done some transactions in New York, and I understand that your organization typically is a bunch of attorneys that do this. So if you do decide you want to do something like this, they'll probably iron out all those rules and make sure that everybody is, in line with the rules and regulations.
Yeah. And we work very closely with, regulatory counsel as part of the transaction to help to analyze existing structures, what the rules are. And, we haven't had issues. Sometimes it just takes some time to go through the process and explain the structure, the governance of the company post-transaction. But so we haven't had any transactions that haven't been approved. It's a lot of times just a matter of timing.
Okay. And then I'll let you continue, but I guess reiterate the tax advantage. So Craig is asking, so the Fed and state never collect any taxes. So I don't think this doesn't remove all state level taxes like excise taxes and things like that. But at the income tax level, how does that work at the state level?
Yeah, so this is specifically around income taxes. Sales tax and excise tax, things like that will still be due. But for federal income taxes and state income taxes, because the ESOP is the one that is technically on the K-1 and required to pay taxes, but the ESOP is a tax-exempt entity, it's not required to remit anything for federal and state income taxes. There are certain states like California has a franchise tax. Massachusetts actually has, I think it's a 4% tax for S corps. So some states you can operate 100% tax free. Other states, New York City also has one. There may still be a small tax that is due on an ongoing basis, even under this 100% S corp ESOP structure. It just depends on the exact location of the business and where the income is being generated.
Okay, awesome. I'll let you continue and we'll jump into some more questions.
So I briefly touched on Section 1042 before, but we can talk about it in a little bit more detail here. Under a sale to an ESOP, it is eligible to potentially be a tax-free sale for the sellers. It does require a number of requirements to be met, and there's also a reinvestment that's required post-transaction. But for individuals that are domiciled in New York or California or other high tax states, it's a very powerful benefit that's only available when you sell your business to an ESOP, and is at least worth understanding and considering. In order to be eligible for this capital gains tax deferral, the company has to be a C Corp at the time of the sale, and the ESOP has to own at least 30% of the stock. On top of that, if you do take advantage of this tax benefit, the sellers that elect 1042 are then not eligible to participate in the ESOP. and their family members are also excluded. So you do have to analyze, does it make more sense for me to get this upfront tax benefit, or would I rather continue to be an employee and receive shares back through the ESOP? Oftentimes for major or majority owners, the upfront tax benefit is worth more than receiving shares through the ESOP, but that's certainly something that we take a look at. The shares that are sold to an ESOP also have to be held for at least 3 years. So I know a lot of people are familiar with qualified small business stock, where there's a 5-year holding period requirement. For 1042, it's a 3-year holding period requirement. Assuming all of those requirements have been met, if you reinvest into what's called qualified replacement property, you have 12 months after the transaction to reinvest the sale proceeds. So let's just use a simple example. If you sell your cannabis company to an ESOP for $10 million, within 12 months post-transaction, you have to buy $10 million of qualified replacement property. QRP is roughly defined as stocks and bonds of U.S. operating companies. There are a bunch of strategies out there to satisfy this reinvestment. You can invest into publicly traded stocks and bonds. It's typically challenging because even if you sell for 10 million, you're not necessarily receiving $10 million of cash at the time of the sale, and there is that 12-month time period. So oftentimes 1042 strategies rely on leverage, where you put a certain percentage of the proceeds down. In the $10 million example, say it's $2 or $3 million of cash, and then you take out a loan for the balance of the sale price, and use the proceeds to buy $10 million of replacement property. So this is something that can be made. It's a decision on an individual shareholder basis. Clients that have stock that's eligible for qualified small business stock then sort of negates the need to take advantage of 1042, since there's no reinvestment requirement with QSBS. So if you're eligible for that, that's certainly the best case scenario. If not, we help clients analyze how this would work and if it makes sense.
Sorry, I was muted. So Michelle wants a little bit more clarity on what the selling shareholder, what their benefit is.
Yeah, so if you sell to the ESOP, obviously you're receiving cash and notes, potentially warrants and other forms of rollover equity. So you're really receiving the cash proceeds and the consideration from the sale. And the benefit is, if you can avoid paying 35% in taxes in this example on the sale proceeds, you're saving, in my example, $3.5 million. How does that compare? If you're one of all of the employees of the ESOP, we can look at how many shares you would be projected to receive through the ESOP, what the projected value of the shares would be, and see what is that crossover period, because it's going to take a while to receive shares through the ESOP that are going to be worth $3.5 million, whereas you get that tax saving today up front. So that's really the analysis, is how much am I personally going to save in capital gains taxes? How much would I be expected to receive by participating in the ESOP, and which makes sense for me personally? Oftentimes for minority, smaller shareholders who maybe don't have as high of a sale value, it may make more sense for them to participate in the ESOP, but it partially depends on compensation levels and what your ownership percentage is expected to be within the ESOP.
Okay. There was another question that came in. What do they require of the trustee?
Yeah. So I think we have a slide in here. I'll just flip to that
later on. Okay.
Now, and talk through. So the trustee has a fiduciary obligation to the employees of the company who are the beneficiaries of the trust. They're looking out for their best interests. So primarily that starts by negotiating for a transaction that is within that range of fair market value. But they also look at, all of the terms of the transaction to make sure that they're fair and that they can justify the terms and the price that's being paid. And then on an ongoing basis, like I said, they're not necessarily involved in the operations of the business. So if you think about hiring, firing, giving employees bonuses, things like that typically do not rise to the level of the trustee being engaged. But if you're going to sell the business or sell a part of the business, if you're going to make an acquisition, those more material decisions are then situations where you would want to involve the trustee, get their input, and make sure they're on board. But as a general rule, the trustee is really looking out for the obligations that are defined within the ESOP plan document as part of the transaction. They do update the value of the company once a year going forward. So as the employees get their benefit statement each year and they see how many shares they have, they also know what the price per share is. So that is based on an annual valuation update that's done by the trustee and their valuation advisor.
Okay, perfect.
I'll flip back to where we were at. I think we're just getting to estate and succession planning. So there's some unique tools from an estate planning perspective that can be used and combined with an ESOP that can enhance the tax efficiency even greater. Post-transaction, the value of the company is oftentimes much lower because we just put debt on the business. And so now the equity value is temporarily depressed until the company pays off that debt. And that creates an opportunity on top of standard estate planning strategies and discounts that can be applied. If you now take the lower valuation and the lower starting place, it can be an advantageous time to potentially move any equity that wasn't sold to the ESOP or warrants into a trust like a GRAT or an IDGIT, or potentially into a children or a child's name and outside of your estate, so that if there is a future sale of the business or future monetization event, you've already moved that equity outside of your estate. So just one other thing to add, we oftentimes will work with owners, personal financial advisors to combine ESOP plans and strategies with estate and other succession planning strategies to create an additional layer of tax efficiency. So quickly touching here on, what is the impact of employee ownership for the company? We've talked a little bit about how it can improve the retention of staff and attracting talent as well. But just a couple of stats here based on studies comparing employee-owned and ESOP-owned companies versus ones that are privately held. And the outcome is ESOP-owned companies are about half as likely to become bankrupt. Oftentimes that is driven by the tax efficiency. Like we said, if you now have an entity that operates 100% tax-free, it puts the company in a much stronger financial position and allows it to potentially weather the storm if performance declines or the environment gets more competitive. But on top of that, employee owners generally have much greater income and also total net worth. But they also have about $67,000 more in retirement assets compared to non-ESOP owned companies. And I think one thing that's worth noting that we haven't discussed in detail is that the ESOP benefit for employees is free. It's different from a 401k plan where you have to take money out of every paycheck and set it aside for retirement. ESOP shares are given out to employees over time as they work there and as they satisfy those eligibility requirements. It doesn't cost employees anything other than their time and effort. So essentially, it's a very powerful tool that gets layered on top of existing compensation structures. Generally, employees will receive the same salary, bonus, 401k plan, existing compensation structure that's in place today, and now receive this ESOP benefit on top of it. Couple misconceptions to talk through here. A leverage ESOP puts too much debt on a company. So generally within the cannabis industry, the outside third-party leverage that we're raising is much lower than what we see in other industries. One, maybe two turns of EBITDA. So from a leverage perspective, it's definitely lower than other industries. On top of that, the trustee is negotiating the overall transaction based on that fiduciary obligation that I talked about. And if there was a company that was over-levered, they would not be able to sign off on the transaction. The seller notes that are issued to the selling shareholders are structured on friendly terms. Generally, they're interest-only notes with no prepayment penalties so that the company can prepay those as excess cash is available. So while it is technically putting debt on the balance sheet, generally that does not impact the company's operations or put them into any sort of bankrupt scenario, since it's in the best interest of the sellers to get those notes repaid. The seller has no say in how an ESOP-owned company is run. We talked about it, but the board of directors really continues to run the operation. Oftentimes, sellers will sit on the board of directors. The trustee may require one or two independent board members to be added to the board of directors. Generally, that's best corporate governance practice, but that doesn't mean that the independent members have a majority of the board. So sellers can generally still be involved and have a say in how the company is run post-transaction. And then from an information perspective, there is no requirement to share any financial information with employees. They have to receive that statement each year that says how many shares they have in the ESOP and what the price per share is. But other than that, there's no requirement to share, income statements, revenue, any other information. Oftentimes, companies will voluntarily choose to share this information to strengthen, the ownership culture, but it is not a requirement. Talked about the trustee's role. So going through some pros and cons here. Sellers with an ESOP transaction can get paid fair market value. That may be in line. We've heard from people in the industry that selling to a third party can be challenging right now in the current environment. You may not receive a significant valuation. So being able to sell to an ESOP for fair market value at least ensures that you're receiving a fair value for the company based on standard valuation methodologies like a discounted cash flow or looking at publicly traded companies. An ESOP trust is a known buyer. And so while we do have to run a process that's structured and make sure, it's within the guidelines and the requirements set by the IRS and Department of Labor, we don't have to run a long marketing process to go out and find a buyer to, hopefully get the value that we're looking for. We're going to set up and create the buyer for this transaction. So it can generally be a little bit more efficient than a sale process to a third party. Financing is available from outside lenders, subject to the typical limitations that for the cannabis industry, many banks are still not participating and will likely be waiting until federal legalization or potentially a Safe Banking Act. But there are some lenders in the cannabis industry that do support operators and that are familiar with ESOPs and can at least provide some upfront liquidity to sellers in these transactions. And then, we talked about the significant tax benefits, both for the sellers personally through its Section 1042 election, but also for the company to operate potentially 100% tax-free post-transaction, creates a significant incentive to consider this transaction. It is, going to require ongoing maintenance and administration post-transaction. So it does require a little bit of an investment to keep the ESOP up and running, but the benefits from a tax perspective while maintaining the company's independence and flexibility are some of the benefits that can at least make it worth considering. And then lastly, just talking through companies and timeline and how the process works. So generally, companies with at least $3 million of EBITDA and above are sort of the quantitative size of when it makes sense to start considering an ESOP. Smaller than that, just can be challenging to support, the diligence, the complexity, and the cost involved with setting an ESOP up. We also typically like to see at least 30 full-time employees to avoid any sort of compliance issues where the ESOP becomes too concentrated. But yeah, generally it's about a 6-month timeline to close an ESOP transaction. It can be quicker than that, depending on the regulatory process and the change of control approvals that are needed, which in the cannabis industry, the regulatory approvals really drive the overall timeline of the transaction. Typically, we get involved to start by discussing goals and objectives with the ownership group, figuring out if an ESOP potentially aligns with what they're trying to achieve. If it makes sense, we continue to the next step, which is running a feasibility analysis. It's a detailed financial model to lay out the valuation, financing, and different transaction structures to really analyze how an ESOP would work and what the cash flows are. And then, depending on if you want to move forward, that's when we'd start to get into structuring the deal, raising the capital, and negotiating and bringing the transaction to a close.
Awesome.
So I think that's all I had. Naomi, I'll open it up to see if there's other questions.
Yeah, so Craig had a question about the income taxes and if there's a 1099 dividend distributed to the owners.
Income taxes are over 40% of revenue. I presume those are distributed to owners as 1099 dividend. So generally, post ESOP transaction, we're no longer making dividends out to the ownership group. What we're doing is selling the business to the ESOP, converting the value of your equity to cash and to debt. And so now the cash flow that comes out once the business is tax-free is a pay down of that note that's issued to you. So if we use my example from before where we sell to an ESOP for $10 million, let's just say we get $3 million of cash and a note for $7 million. Post-transaction, now the company is operating 100% tax-free. It's going to use that cash to pay down the $3 million bank debt, but also to pay down the $7 million note that's issued to the sellers. So the income that's coming out now is sort of a repayment of that seller note instead of a traditional, dividend or distribution.
Loans are not taxed.
Right.
Yeah. Okay. And then I think you answered Craig's question in the last slide about the size, 3 million and 30 employees, right?
Yeah. So existing shareholders.
Still a little confused. How can existing shareholders sell the ESOP if they can't participate in the ESOP for the benefits? Most New York dispensaries or other licensees are owned by under 6 people. Minority and women-owned businesses have to have the minority group own 51%. Does ESOP work in these cases?
Yes, it can work. So the requirement is employees that work. So generally, it's full-time employees. So if you have any part-time employees that only work a few hours a week, they would not get picked up. But the requirement to have at least 10, 20, 30 full-time employees picks up all employees that are working at the business, not just owners. So there's a difference between, licenses are owned by under 6 people, but really what we care about is how many people are employed and working at the business. And that has to be at least 10 or 20. And then separate from that, the minority ownership group that owns 51%, they may need to, depending on how the license was issued and what the requirements are, they may need to maintain ownership of that license. But like I said before, there are ways to keep the ownership of the license outside of the entity that's sold to an ESOP if you're willing to sign some sort of service agreement where the value can still be included. So I think this is starting to get a little bit specific where it depends on each situation and the structure of the license and how they were issued. Oftentimes we can find a workaround, but it just will depend on the specifics.
All right. Let me know if there's any other questions or anything that I may have missed. I think Angelita was just kind of making a statement here that legal ownership and equity ownership are different. So in a trust, the beneficiaries have equitable ownership, not necessarily legal ownership.
That's right. Yeah. So that's kind of what I mentioned before, where all the employees of the trust have a beneficial ownership, but not necessarily legal ownership. So oftentimes we don't see regulators testing the employees that have a beneficial ownership. It's more about who has the legal ownership of the license, if it's the company or an individual, things like that.
Awesome. All right. Well, I don't see any new questions. Everybody understand, ready to deploy your ESOPs. It's very complex transaction, so you do need a team of attorneys in place that understand it. Andrew's information is on the screen, so if this is something that you think will work for your organization, or in the future, take his information down and they can analyze it and see if it'll work out. But yeah, any last thoughts, Andrew?
Yeah, no, like you said, feel free to reach out if anyone has any other questions or wants to discuss a specific situation. We're happy to help with ESOP education as we showed today, and happy to have conversations. But yeah, thanks for having me, and good luck.
Awesome. Thank you, guys. Talk to you later.